lot of agitation about what has happened in the housing market and whether the American dream is still within reach. Of course, because of the rise in interest rates, that figure is now up around 70 hours of pay for the median worker. I described it earlier as being stuck in the mud. I think that's still the case. We'll have some ups and downs, but hello and welcome to another edition of the Economic Update. I'm Kurt Long, the head of Emerging Issues and Deputy Chief Economist at America's Credit Unions. So this month I want to walk us through a couple of things. The first is the recent forecast that the data and research team just released, the second quarter forecast for both the macroeconomy and the credit union industry. And then I want to do a deep dive on one area of the economy that we probably haven't talked much about recently, and that's housing. But first, let's talk about our latest forecast. And I really just want to highlight a couple of developments as they relate to our forecast. The first is inflation. As you probably know, recent inflation readings have been much stronger than we saw in the second half of 2023. And that has really dented hopes that we're going to get rate cuts later this year. The forecast that the team has put together still calls for 1 to 2 rate cuts in the second half of 2024, but I think it's very possible that we get no rate cuts. Certainly if the recent inflation readings that we've gotten persist, I think a 0 rate cut scenario is very much on the table. The other thing that we've seen recently is first quarter GDP just came out, and actually that's come out since we released the forecast. It came in at a number below what we had forecasted at America's Credit Unions and well below consensus. Our own forecast was below consensus, but the first quarter GDP actually came in even below what we were expecting. So that has raised concerns, especially in an environment where we are still experiencing inflation that's too high and beginning possibly to reaccelerate. And so the word stagflation has come back into the vernacular. And so I think as we think about these two issues, GDP on the one hand, inflation on the other, I think it's a little too early to be worried about stagflation scenario. Actually, if you dig into those first quarter GDP numbers, it really wasn't that bad. Consumer spending, which is the most important part of our economy, remained very strong. It was some other more volatile elements like net exports, private inventories that were weak. And historically, those elements, if they're weak in one period, they aren't necessarily weak in the next. So something to keep an eye on, but I'm not too concerned at the moment. I do think, though, as we look ahead, it does raise the risk that we could, if we enter a scenario where economic growth is a little bit weak, the Federal Reserve may not be in a position where they could cut rates to address that weakness because inflation is too high. So there is the risk, I think an elevated risk of recession, as much because we've seen high inflation as because of those first quarter GDP numbers. As we talk about the industry outlook, the team, I think, feels that we'll see a lot of the same challenges that we saw in 2023, maybe a little bit of thawing, you might say, in some areas. We're expecting share growth to be a little bit higher in 2024 than what we saw in 2023, and that should help with probably the biggest ongoing challenge for credit unions, which is liquidity. However, we do continue to see a very challenging earnings environment in 2024. All right, let's talk about housing. Again, an area of the economy we haven't really talked much about recently. The housing market in general has been sort of stuck in the mud lately. And the biggest reason, of course, is that affordability conditions have been so bad. So there's a lot of ways to think about affordability. I think the way that I prefer is to look at what is the monthly mortgage payment that a typical household would have to make if they were going to buy a house today, and then let's compare that to what a typical household is earning today. So in this chart, that's exactly what I've done. I've taken the median worker and their monthly income, and I've asked the question, how many hours of that median worker's monthly pay would have to be spent making their mortgage principal and interest payment for a given month, given where rates are, given the median house price out there. And this chart shows the dramatic rise in the number of hours of pay that it takes to make that payment. Prior to the pandemic, we were down around 40 to 50 hours of pay required to make that payment. And of course, because of the rise in interest rates, that figure is now up around 70 hours of pay for the median worker to make a principal and interest payment on the median home. And I would say that is also before taxes. So the true number is actually even a bit higher than that. So you can imagine for a single earner household, they really are feeling like they've been priced out of the housing market these days. It's probably a good reason why consumer sentiment has been as low as it has been. A lot of agitation about what has happened in the housing market and whether the American dream is still within reach. Now, I would say I think this chart is helpful because it does give us a little bit of context. The fact that we're up at the affordability or lack thereof that we are these days, it's not unprecedented. And in fact, in the run-up to the great financial crisis, affordability conditions were very similar. Of course, that was a very different housing market, a very different macroeconomic environment. But I think there is some sense in which, it's just adjusting to, I won't call it a new normal because we don't know what is ahead, but at least it's been the prevailing normal for the last couple of years. Here we're looking at a chart showing housing sales, both resales, that's the darker shaded series there, as well as new homes, the lighter colored series, which typically represents about 10% of sales, give or take, historically speaking. And you can see how much sales have collapsed over the last couple of years as those affordability conditions have deteriorated. Most recently, we have seen a little bit of an uptick in purchase activity. So that's good news, but I think that's probably going to be short-lived. Generally speaking, I think we are in sort of a holding pattern. I described it earlier as being stuck in the mud. I think that's still the case. We'll have some ups and downs, but generally until we get some thawing in terms of additional inventory, and most especially interest rates, I think we're sort of stuck in the position that we're in right now. Now, prices in general have been pretty stable. In fact, recently they've been going up if you follow various indices like Case-Shiller, still on the rise, but I do think we're starting to see some downward price pressures. This chart is showing us the share of home listings on Zillow that have seen recent price cuts. And so each of those lines represents a different year. I wanted to highlight, though, just the last three because they have been such outliers. Starting with 2022, of course, we came into that year with an extremely tight housing market. Nobody was making price cuts. And as that year dragged along, we know what happened with interest rates, and the housing market really flipped on a dime, such that by the second half of that year, there were significant amount of listings with price cuts. And we saw that come through in the aggregate price indices. There were downward price pressures that showed up in Case-Shiller. Fast forward to 2023, and we had a generally stable pattern, but with elevated levels of price cuts. So again, prices were pretty flat last year. Now, go forward again to 2024. What are we seeing so far this year? Well, we came into the year with a somewhat lower level of price cuts than we did in 2023. That's changed, though, recently. In the last few weeks, we have started seeing quite a few more price cuts than what we have seen in any recent year. So I think this is something that certainly bears watching. I don't think that we're on the verge of a collapse in home prices. Primarily, that's because the labor market remains in really good condition. But I do think this is something that bears watching, and I think overall, because affordability conditions continue to be difficult, we're probably going to see some pretty flat pricing over the remainder of the year. The last thing I want to think about as we're talking about housing is construction and how that plays into the purchase market. So we're looking here at home completions, and I've broken it into single family versus multifamily because we've really seen the two series detach from one another in the last couple of years. So pre-pandemic, both single and multifamily construction activity was occurring in pretty much level terms, both growing at about the same pace. End of 2021, beginning of 2022, multifamily saw some weakness, but more recently, we've seen really strong activity in the multifamily sector, while single-family home construction has been flat or even down. So as we think about how this plays into purchase activity, and of course, as multifamily inventory comes online, that has the effect of absorbing a lot of the housing demand out there. Of course, it's not going to result in purchase activity, but it will have some effect on pricing as households consider whether to rent or to own. If rental prices are modest because inventory is coming online, that may affect their decisions. And in fact, that is what we see. We see rental, if you look at various sources for rental prices, you do see some weakness that we don't see in terms of the single family pricing indices. So that is something to keep in mind. I think as we look forward, though, and if you look at the data on permitting, this relationship has really flipped, where we've started to see a lot more permitting and home builders starting to take on single-family projects, and multifamily has really declined. So that could be good news down the road as this inventory comes online. It could result in some extra sales activity. All right, so wrapping this up, I think for the rest of 2024, as I said, I'm thinking that home price growth is probably going to remain flat. That is, because we have some pressures on the downside. I showed you the price cut data. I do think that bears watching. I don't think we're going to see a collapse in prices, though, because the labor market does remain so strong. With that said, I don't think that there's going to be much change in purchase activity this year. Again, as I said, the inventory situation, such as it is, just is not going to allow for it. But as we think ahead, that could be a story in 2025. We're going to get some new single-family inventory probably next year. And so that could be a developing story. But I think for now, we're probably sort of stuck in the mud still. The last thing I would point out is that in this environment of high interest rates, I expect we're probably going to see some greater metro to metro variation. And that's because the construction activity is going to vary even more than it has. You can think from the standpoint of home builders, probably the large national home builders are going to be able to continue with their construction projects, but some of the smaller builders may not be. And so, depending on whether your metro area is more or less exposed to this, you may see very different outcomes in terms of construction projects being started, being completed, that inventory coming online. Of course, that has implications for prices and affordability, but also for sales volumes. So, with that, that will do it for this month's economic update. So until next month, take care.